2017, equity markets rallied, with emerging markets achieving strong double-digit returns and bonds returning between 6 and 9%. After an 8-year equity bull market rally, are there still investment opportunities in 2018? We spoke with Citi strategists on the outlook for the year ahead. Julia, global economic growth achieved a broad-based recovery in 2017. Can investors expect that to continue into 2018?
I think 2017 has certainly surprised most of us in terms of how benign it's been across markets. And we're hopeful that we're going to see the same in 2018, possibly with some moderation. Our economists predict global growth at about 3.4%. I think in the US, we see an acceleration toward about 2.7%. And the main driver for that would be the tax cut stimulus. In China, we see far greater focus on structural reforms now that the 19th Party plenum is out of the way. And that should see China at about 6.5%. The unknown now is obviously the acceleration of geopolitical risks. At this very moment, Europe presents the biggest challenges with Brexit negotiations underway, and also obviously the upcoming Italian elections.
With global equity markets hitting record highs in 2017 in a number of countries, are there still opportunities for investors going into 2018?
2017 has been an extraordinary year for equities investors across the board. And again, just like with the broader economic growth, it would be a little unrealistic to expect exactly more of the same. But we do see a lot of opportunities. For instance, we like Asia from a valuations and economic growth outlook perspective. We think the weaker dollar is a benefit to Asian markets. And overall, CapEx should have given Asian companies better earning potential overall. We think many of these themes translate broadly into emerging markets and into some parts of Europe. From a sectoral perspective, we think global earnings growth will also benefit cyclicals like technology and materials, and obviously rising interest rates will be good for financials.
Umar, is there a risk of stronger than expected inflation going into 2018?
Well, inflation is bottoming out amid a broadening growth outlook, but we have to remember that inflation has undershot our economists' expectations for the 6th consecutive year, and there are persistent and structural factors behind that. I think we do see upside risk to inflation from commodity prices in a tightening labor market, as you point out, but our forecast is relatively subdued, with inflation at 2.4% next year, similar to this year, and we see the risks of that forecast as relatively two-sided or balanced.
Citi projects that the U.S. Federal Reserves will raise rates 3 times in 2018. Other central banks are likely to raise rates as well. Is there a risk of faster than expected rate hikes going into 2018?
The market certainly is not pricing in the 3 Fed hikes that we are expecting next year at the moment, and we've seen a significant move upward in LIBOR already. In terms of mid-duration bond yields, we expect the impact to be relatively contained because of the subdued inflationary backdrop that we talked about, and also the expectation that default rate remain low, growth remains positive. So we remain quite constructive on high spread sectors like high yield and the emerging markets, which will also benefit from a weaker dollar.
Manish, what's the impact of the U.S. tax reforms on the U.S. dollar?
Though the tax reforms are likely to be positive for equities and US dollar, but the prospect of a watered-down tax bill with delay in implementation of the tax reforms are likely to cap dollar gains. Euro, on the other hand, looks well supported given a cyclical recovery in the economy, a large current account surplus, and a less accommodative monetary policy by the European Central Bank.
And what's the outlook for Asia-Pacific currencies?
Our Citi analyst expects two-way fluctuations in CNY, while strong inflows will support the currency, but the People's Bank of China intolerance for a strong currency will limit the gain. We like Malaysian ringgit, given low volatility, stable energy prices, and outperformance in growth. When it comes to developed Asia, the Australian economy continues to face headwinds, given a plateauing housing market, weakening retail sales, low wage growth, and high debt burden. We think the prospect for Australian dollar is not positive in the near future.
We hope you found these insights useful. For more information, please speak with a Citigold Relationship Manager.